To this point, we've been talking about the whole formal process of a sales order, right on through invoice to customer payment. But you could have walk-in sales or people that just order things and you issue them a receipt. So here is an example out of QuickBooks where Electrified Arts and Toys came in and bought some Dipsy Doodlers from us. So we issued them a sales receipt for that. They gave us a check for $375, as you can see the green highlighted check there. So that's that transaction. But it could be a point of sale where we're at a cash register and we record things in that cash register. You'll notice the little sign in between. This is an auditor's tool, again, to make sure that all transactions are recorded so that some person out on the cash register isn't pocketing those sales. So we put up a sign that says, if we don't hand you a receipt with your purchase, your order is free if you tell us straight away, that is. So essentially, it's trying to get people to sit there and go, oh, wow, if they don't give me a receipt, I get my order for free. And that receipt is the system generating it so that we know it's a transaction that's been put in the system and recorded as such. So that's a little bit of an auditor's tool that you want to look for in an environment where you've got a cash register. Other cash register controls include that the whole password protection for getting into the cash register itself and making sure that if you're the person working the register, you're the only one doing it. So if someone else comes in and does a transaction, they have to put in their code so that we know that it's that someone else who did the transaction. We're going to reconcile and balance that cash register at the end of the night. And that little strip of paper that comes out, there's something called a Z total, which at the end of the day, they'll print out the Z total and it'll show all the transactions that happened with that register. It allows you to balance that with the cash and submit that into the accounting office so that you know you've reconciled. As a good auditor, you might want to do surprise audits on that cash register because what people will do in some of the schemes is overcharge customers but only record lower amounts of sales, and they'll put that difference in the till so that even though we may have charged the customer $25, we may have only put it into the system as 20 so that we know $5 we're going to steal at the end of the day. But if we do a surprise audit, we'll see that there's an overage in that register, and that's an indicator that someone's trying to skim or steal from the company. We can also have credits and returns. So let's say, for example, our Euro toys, two of the Tartinga packages were ripped or opened and some of the Tartingas were damaged. They wanted to return those. So we're going to accept that returned product. So we should have some documentation related to that, whether it's the shipping information, correspondence, emails, things like that. And we'll issue them that credit memo, receive those goods back in to our inventory. So in this case, they've already paid, so we're going to issue them a credit memo and keep that on their account, hoping that they'll order something else, or we could turn around and issue them a refund check. These are things as an auditor you would follow through on the checks that were issued for refunds or these credit memos, make sure they have the proper authorization. Another area that I wanted to discuss, though, is pricing errors. Sometimes the credit memo has nothing to do with product, but more so that we overcharged the customer or there was something wrong with the price. So we'll issue a credit memo related to that. Again, there should be some authorized communications as an auditor. You should be able to see for that. And there might even be a contract. Maybe the contract said they should have been charged less. They were accidentally charged the regular price. And so there should be a contract to show that, yes, this company gets a lower price than everyone else. So that's something to think about when you get into credits and returns. So you'll see in our little sales journal down here, we've actually credited our accounts receivable and debited our sales for these returned products, and also put those products back into our inventory and reduced our cost of goods sold. Now, we may wind up deciding that these are throwaways and wind up scrapping them or writing them off from our inventory, but at this point, we're returning them to inventory. Maybe they just need repackaging in this particular case.